Yeah. Hi guys, good morning. My name is Satya Prasad and I born and brought up in Hyderabad and I completed my BTech from Satyabama University, Chennai in computer science and engineering field. And my hobbies are my first I need to start with my strengths. My strengths are leadership skills, communication, and able to analyze data and present the information in a clear and understanding way. And when it comes to my hobbies are reading books, like reading, getting new kind of newspapers, and being up to date. And my coming to extracurricular activities are playing games like volleyball. Those are some of the extracurricular activities. So the reason that I joined the SIBA program is actually uh, why I choose IB is actually as a non-finance background. I came to know when I'm in the college. I came across these finance fields, mostly stock market and everything. I am very fascinated about this topic and want to learn more about it. But due to from non-finance background, I don't have a clear path where to go, where to get all the information required. But I came across some articles, and in YouTube videos I came across these specific topics, and I gained some kind of some knowledge in the topics. But what I lacked is a clear understanding and clear path to get into a finance. So later I came across this SIBA program. In the SIBA program, it is a clear cut program, placement oriented program for 3 months, and so that I felt like using this program I can get into an investment banking field, and there I can get into and get a real life experience and build my career in that field. So that's why I joined this program. And now today I'm coming to the topic. Today I'm going to present about cash equities. So Ati, can you please change the slide? So first of all, we need to understand what equity is. Equity is nothing but a ownership in the company. So like if there is a company, if we are the owners of the company. So let's take there is a company which is running business like a paint company, and that company, there are some owners who manage the company and who is the ultimate beneficiary of the company. And equity, what it represents is we are the ownership of the company. And when it comes to the term cash equity refers to the equity which is in the liquid portion of the company. Liquid portion means liquidity means an asset which can be easily converted into cash without change, without any fluctuations in it fair market price. Like let's take, so if you take a flat, like the cost of the market price of the cost is 1 cr, and in case there is emergency, you need to sell, you want to sell the flat, but you can't able to sell the flat immediately because you need to find lot of buyers and you need to go through lot of legal process and everything, because it is a high ticket deal. And also the valuation of different real estate is very different, right? So it is non-liquid asset. But when it comes to equity, like a share of a company, like in public markets, like for example, let's take a share of HDFC Bank. So we can able to easily buy those shares, and also if we are owner and we want to exit from the company, we can easily able to sell the shares in the market and get our money back in the cash format. So that is what cash equity refers to. And also in equity, as I said in the flat example, let's take the you purchased you financed the flat, like let's say the price is 1 cr, you brought it for 1 cr, and you have gone for 80 lakhs as loan and 20 lakhs as equity. But if you want to, this is also equity, it is called as illiquid portion of equity, it is not liquid. Yeah, that is the main reason. And next slide, I think. So here are some advantages of equity. The main advantages of equity are it carries voting rights. What is voting rights means? If we are the equity ownership, we can able to influence the decisions of the company according to what we feel and what we benefit the most. Like let's take there is a company and we can able to elect the board members, the CEO, and everything for our benefit. So if they perform well, the management performs well, like the management team, you will get more money, more returns, right? Like the share price might appreciate more. So it carries voting rights. And the second is capital will remain with the company until the liquidation. What did this mean is actually in equity, when we buy a equity share or if we finance a, if we invest in a company, we will not get the return. They will not return our equity capital back. We will only, because we are the owners of the company. But in case if you take a bondholder, the bondholder has certain period, like in 10 years the company will give us back our principal amount. Like let's take, there is a bond of 100 rupees face value, and we will buy at a interest rate of 5 8%, 10%. But after 10 years the company will return us 100 rupees, and after 10 years the interest rate might be low, like 5% only. What happens is, again we need to we will get our 100 rupees back, and again we need to find new opportunities to invest 100 rupees at a more rate of return than the this return. But when it comes to equity, we can able to get into the we can be able to purchase that equity at very high discount rate, like 10%, 15%, and we can able to continue in long term without any feeling like no reinvestment risk, without any reinvestment risk. And the third one is they outperform other classes, because equity holders are the ultimate beneficiaries of a company, and whenever the company generates more and more income than their interest amounts, the excessive income will all goes to the equity holders. As the excessive earnings accumulate in form of retained earnings in the company, the value of those earnings will be lot more than the when you are purchased. So that's why the share price will increase, and you will get a good appreciation on your asset, on your share amount. And whenever you want to exit, you can sell it in higher price also, and you will also get dividends amount. And the last one is liquidity. In liquidity, what it means is, we can able to easily convert our equity shares into cash by easily selling in the market, in secondary market, like BSC, NSC. We can able to sell and get our money back. And the next slide, I think. And when it comes to disadvantages, the more one of the most disadvantages thing is, we are when company, let's say if a company goes into bankruptcy, as equity holder we will not get nothing, because we are the people who is going to face unlimited losses, because the bondholders will say we need the money, and they will take the surety amount. But as equity holders, we are the owners, we need to bear the whole consequences of losing our whole equity amount of capital also. And the second is huge market fluctuations, like as you know, equity prices are like share prices are determined by demand and supply characteristics in the market. Let's say if there is any negative news in the economy, like let's say there is a COVID lockdown, so it is a negative news for a company, negative news. So what happens is, in that case the people will might feel fear, and they might sell a lot of things, so in return the share prices will fluctuate a lot, so share prices will fall. So it is one of the disadvantages. And the third one is, there is no fixed return in equities. Like in case of bonds, we will know how much return we will get in what period, and when we will get our principal back. In case of equity, we couldn't able to explain that we will get dividends on this year, and our capital will be appreciated by this percent. We can't able to predict those things. That is the disadvantages of equity. So next slide, I think. So now we are coming into different types of equities. Now, in case of basic terms, there are few things. First is authorized capital. In authorized capital is nothing but the maximum amount of capital the company or board of directors can issue according to their articles of association. Like every company needs to register themselves in Minister of Affairs, and in there will be a certain clauses like articles of association. There they need to mention how much capital they're going to use, how much capital they can maximum issue in the market. So it is no nothing but the maximum capital the company can raise. So the second thing is issued capital. Issued capital is, let's take there is a company, Reliance, which has a maximum authorized capital of 100 cr, and now the company wants to raise 50 cr from the market to expand a new project, like the open a geo, those kind of things. That is what issued capital. In the 100 crores, the company has issued 50 crores to the public with the help of IPO. And the third one is subscribed capital. In the 50 crores, how much amount of capital is being subscribed is called a subscribed capital. Like Now the company has offered 50 cr to the public to by issuing them shares. Now the public has only bought 40 crores worth of shares. Then the subscribed capital is 40 crores, and the unsubscribed capital is another 10 crores is called as unsubscribed, and the last one is paid up capital. Now the shareholder has subscribed to the share, and now the company will say, okay, you can give us money for 6 months. In 6 months you can pay, now you can pay 20% of the amount. After 6 months you need to pay extra 80% of the subscribed amount. Like, let's say you have been allotted a share worth 100 rupees. Now the company will say, now you need to pay 20 rupees, and after 6 months you can pay another 80 rupees. The 20 rupees now it has been paid is called as paid up capital, and the remaining 80 rupees is unpaid capital. It will be paid after 6 months. Now when it comes to issue terms, the first is face value. Face value is the amount which has been printed on the share. Like a share means, actually previously how share used to be is, it is a piece of paper where the company will say, this is the owner of the company represent this much amount of share amount, and it has been signed. So but the share has to be of certain amount, right? So that only the value of the share will be decided. So it is nothing but a amount which has been printed on the share paper. Share certificate is called as face value. And the second value is book value. Book value is nothing but, if you take all our assets and minus all our liabilities, we will get a certain amount, is called as book value. It is the amount, the residual amount the equity holders will able to get if the company is liquidated at the right now itself, is called as book value. And the third one is issue price. It is a price the company has issued to the public when the company go through an IPO process. And the issue price can be, the company can decide the issue price in two ways. One is fixed pricing, and second one is book billing. So here are two ways, and the last one is share premium or discount. So how much amount the company has issued in premium or discount is called this thing. Next one, I think. So next I'm going to tell about preference shares. Preference shares are class of ownership in a company, which it is a type of hybrid share. How it is going to perform is, actually the preference shareholders will get a fixed amount of dividend, uh, in like they will get a fixed amount of dividend just like interest amount. So that is what preference shares. Unlike bondholders, they will get higher return than the bondholders. Unlike but they will get the advantage that they, when in case the company get liquidated, they will get a more preference than the common shareholders, but they are subordinate to the bondholders. And here there are four common types: cumulative, redeemable. In cumulative, let's say the company has said we are going to pay 5% dividend every year, and in case the company is not able to pay 5% dividends this year, the company should pay this 5% plus next year's 5% dividend next coming year. That is what cumulative dividends. And next is redeemable. Redeemable is the company can redeem those shares to itself. And these are some of the features. Next slide, please. And the advantages of preference shares are, it provides a stable dividend income. And the second one is like, you need not to think like, we will I get any return or not. And the second one is preference during company liquidation. Like, in case the company gets liquidated, we will get more preference than the common shareholders. And the third one is cumulative options. Like, the if the company not able to pay dividend this year, it is to pay dividend in the next coming year, and it all will be added up so that we will get a fixed kind of return. And the fourth one is convertible options. Like, some companies issues convertible preferences. Like, in case we can able to convert those preferences into common shares by a predetermined price and number of shares, those can be happen. In case the company has performed well, we can exercise this option and get those. We can convert those shares into common shares as a owner. And the disadvantages is, there is no voting rights for preference shares. And the second one is, we can't able to influence the decisions of the company, and we can't able to say anything in the company. We are just giving our capital and expecting a dividend return. And the second one is limited capital appreciation. Like, we will only get the limited dividends, right? So we can't able to, like in case of bond or equity holders, in case the company performs well, the all those savings will be added up to it, and the company will get more appreciation in the market. But in case of this, there only limited appreciation because we'll only get those fixed income kind of returns. The third is interest rate risk. Like if say the company has only giving us 5%, but if the say the in the market conditions, let's say the it is 8%, we are losing this 2%, right? It is a interest rate risk. Yeah, next slide, I think. And next, we need to get. I'm going to talk about ADRs and GDRs. First, we need to understand what are depository receipts. Depository receipts are negotiable financial instruments that represents a ownership in the company, ownership of a foreign company. Like first of all, in this definition, there is a two words called as negotiable instruments. Negotiable instruments means instruments which can be traded or which can be bought and sold in the market is are called as negotiable instruments. And this issue, these shares are not belong to the this country itself. Like let's say there is a company, Infosys is issuing their shares in US stock exchange like NSC, and without going through the IPO process, they are issuing their shares in the foreign company. So that what are the main advantages is the company will able to raise more amount of money, because in US the available capital is lot more, so the cost of capital will be low, right? So that is one of the advantages. And the second advantage is for shareholders of the US company, there are shareholders, they can able to easily sell their shares in their exchange also, without any like a transaction cost or foreign exchange changes and everything. And also it has been denominated in their local currency itself. And this is what depository is. Next one, I think. So now we need to talk about ADRs. ADRs are foreign companies issuing their shares in US stock exchanges are called as ADRs, and they will be issued in US denominated dollars, and they can be traded in US stock exchanges, and they represent a ownership in the company, so that it carries voting rights also. So it is what ADRs is all about. Like next, we need to get into GDRs. I think next slide. Okay, yeah. GDRs are companies same as ADR, but in case of GDRs, it is not like any country other than US. Like there is a foreign company which is issuing their shares in any other country other than US in the stock exchanges is called as GDRs. There is an Indian company issuing their shares in the European country like UK or UK in London, is called as those shares are called as global depository receipts, and they are traded in their local currency where the exchange, like in case it is issued in London, their official currency is pound, it will be traded in pound only. And GDR provide like it is more bigger pool than the ADR, because ADR has lot more restrictions than GDRs. So GDR is very less restricted, and it can be we can have a lot more benefits in GDR also. Yeah. And also one of the thing that I observed is the companies which are issuing in the foreign currency, or let's take the Infosys, a lot of business interest in US, like they get their major revenue from the US companies only. And what I observed is whenever the company is issuing their shares in a foreign company, that company has business interest in the country. So I think what I can feel is there they have good investor network, so where they can easily raise the money. Yeah. Next slide. So here are some major differences of ADR GDR. You can go through this. Yeah. Yeah. Okay, I think change the slide. Yeah. Okay, guys. Any questions? Okay. So I want to ask. So actually, I'm going to raise some questions. So as I said, the advantages of cash equities compared to other equities, one of the advantages is liquidity. Can anyone explain what liquidity is all about? What does liquidity mean by? Hello.
Converting the cash equity into the liquid asset.
Okay. So is there any specific criteria that we can able to convert any asset, right? Let's take a real estate, or like there is a flat. We can also be able to convert those that asset into cash. But why do we call liquidity this real estate or flat asset as illiquid asset and this share as a liquid asset? Okay, I will.
Short term abilities.
Yeah, actually, uh, so the shares are can be easily converted because there is a lot of market for them, like stock exchanges and market dealers. We can because a lot of buyers and sellers, and this securities has been easily daily tradable, so we can able to easily convert those cash, right? In case of flat, we need to find a buyer. Later, we need to get a person who is going to value this whole property and everything. Though it process take at least 1 year, and also the negotiation of prices is a lot different in real estate. Yeah, so that's all, guys. Yeah.